I make $1 million a year. There's a lot of misconceptions about what the day-to-day of private equity looks like. Most people don't make a lot of money in the VC world.
The idea of looking at the life of a business is just like a human, that inevitably you are going to die. It's going to be over. We don't ever think about death. We act like we're never going to die. And it's the exact same with capitalism and business.
One of the biggest underlying factors I see over successful founders, and the individuals who are motivated because they want to make money.
The money, Skylar, where is the rest?
Sometimes they find success. But what I've noticed is when they meet failure, they're the first to quit to go find easier money.
Yeah.
Because their objective was to make money.
When we started raising our first fund, it was the worst time to raise capital, like ever.
Thanks so much for joining us today. We're going to kick it off with our typical opening line of questions. So can you tell me about your first job, your worst job, and your current job?
Sure. So first job, I worked at a pawn shop in downtown San Diego. Really interesting environment. I learned a lot, probably more than I've learned doing almost anything else, both because it was my first foray into a professional working environment, but also because it's just such an interesting environment to work within. Even now today, I often reflect on the shared skill set that I learned there, from negotiating to building that rapport with customers to identifying unrealized value, probably at the top of all those things that I've learned about. But definitely a little chaotic, a little interesting of an environment, of a customer type, sort of all walks. I think you can liken the pawn shop, especially whatever this was, almost 30 years ago, to sort of, a Main Street bank in a lot of ways, or an underground bank in a lot of ways. And that comes with a certain...
It's a type of banking.
It's a certain type of banking, yeah. Sure. It's
type, maybe.
Oldest type out there. I guess I could say I've been a banker for a long time, but a really valuable experience for me all around. Worst job, I was a diesel motor fleet tech for maybe a year or so while I was in college.
Is that where the term elbow grease comes from?
Yeah, I mean, it's full body grease. It was. For any of you out there who work on cars, diesel motors are heavier, they're bigger, they're beefier. It tends to be a harder bolt to turn, a larger part to lift, and for me, it was diving head first into a career that I was actually kind of interested in the moment, and pretty quickly learned. It's too hard, too heavy, too long hours. But I think the thing that made it worst for me was not that it was difficult. Difficult does not equal bad, although certainly challenging. And in the moment, I probably had some bad feelings. But it was the management structure. You have a shitty boss. It can turn a great opportunity into a terrible one. If you have an amazing boss or team, it can turn a really challenging opportunity into something really fulfilling. And this was a great lesson in how to not run a team. And it became really challenging for me to want to engage with that kind of leadership. Yep. And as most worst job stories end, I sort of went out with a bang. Admittedly, pulling a motor out of a car through a chain link fence with a forklift, and leaving the forklift running and walking off the lot. I remember going to the accounting gal who worked on site and just said, I know it just caused some damage. Why don't you keep my last check? I didn't earn it anyway. I'm going to walk home. And I walked home and never came back.
There you go.
Wow, great story.
Not necessarily something I'm proud of, but I think we've all lived through one of those burn it all down moments. Thankfully, I did it really early in my proto career. And best, I don't want to give a non-answer, but I've had the pleasure of leading a lot of really awesome teams, small and mid-sized teams. And the application has become less important over the years. The what we're doing has become less important than the who we're doing it with. But, my current role, I'm a general partner in a private equity fund, Verde Equity Partners. And that team was largely assembled with me sort of at the crossroads of how everybody was relationally related. So I feel a little responsible for bringing us together. And when I reflect on, who would I want to work with, both the actual individual, but also the archetype, right? What type of person, people would I want to show up and really collaboratively build something with? It's those types of people, right? To the T. Incredibly challenging job to do every day. There's a lot of misconceptions about what the day-to-day of private equity looks like, but the people foundation of that business makes it the best job I've ever had every day.
So if I wanted to get in private equity, I should become a diesel mechanic?
Yes.
That makes sense.
Got it.
Honestly, though, so on that note, just as a joke, or not as a joke, but taking that joke, elevating it a little bit, a lot of the non-sort of standard track private equity professionals I've met, the guys, the gals who don't come from finance degree, MBA, analyst, associate, the classic track, right? Which there's nothing wrong with. I think there's a lot of benefit to living through that classic track, which I have not lived through. But the alternative track is that industry expertise track, right? It's intimately understanding the mechanics of a niche, hopefully defensible industry. And that could be in mechanics, that could be in anything, right? I think often when we think about private equity, we think about the industries that dominate the news, the funds that dominate the news cycle. Those are mega funds. Awesome, amazing achievements, incredible work that they've done. But, we can sit in a room like this and we could look around and go through a thought exercise of how did private equity enable this to happen today? And we don't have to reach within probably arm's length right here before we can start touching an industry that private equity has meaningfully engaged with and hopefully added a bunch of value to. So knowing an industry intimately, whether it's being a diesel tech or whether it's being a toothpick salesman, whatever, there is an identifiable through line from selling those toothpicks to consolidating the toothpick industry, as an example.
Mm-hmm. So, two things. For anybody who doesn't know, could you please explain what private equity is and how you got into it?
So it is a bit of a catch-all term, which is a bit of a mixed blessing. You'll see on, primarily on Reddit where we engage with each other, that there are a lot of misconceptions. I think the classical definition is truly just, capital deployed by private entities or individuals into private businesses.
As opposed to public companies.
As opposed to public companies, right? When we talk about the market, colloquially, we're usually talking about the public equities market, right? Not the private equities market. And again, as a catch-all, we could argue that, is buying a table on Craigslist private equity? I don't know. Mm-hmm. But it is that simple in the sense that it's private capital being deployed in private markets, most commonly in businesses, operating businesses, to a lesser extent, real estate and some of those other assets that are usually complementary to a business. But the less catch-all term, or less catch-all meaning, it's usually firms that have a fund vehicle, a legal vehicle for housing a bunch of people's money, people, institutions, retirement funds, sometimes other businesses, sometimes even funds of funds, right? Funds that exist to fund other funds. It gets a little meta there. But private capital in a pool that's being deployed typically to acquire really high-quality companies, right? And high quality through the lens of predictable profitability, defensibility, right? Companies that have been around a long time are often really attractive to private equity buyers, and that usually have some sort of untapped, meaningful upside. And that can look like a couple different things, but in the middle market where we play, which is another ill-defined term, which we don't need to go down this rabbit hole of like, what's the middle market? Because it's whatever you want the middle market to be. I don't know. As an aside, once I was at a trade show and we were talking to one of the MDs of the Berkshire Hathaway PE arm, really prolific guy, having this fireside chat, and we all in our mind had this middle market definition, right? It's insert number, $300 million companies and below, whatever, right? And then we we're hearing this guy talk, and somebody asks, because he referenced the middle market a bunch, what are you talking about? And he said something that was so like to my little brain. It's like, oh, anything under $2 billion, insert huge number, and we all just about hit the floor and said, oh, we're not even in this game, right? But so in the middle market context, as we look at it, it's kind of businesses that are between usually, $5-10 million in revenue to maybe a few $100 million in revenue. And those companies often have a similar sort of shape of opportunity that exists. Often that's an older founder who's an owner-operator, or maybe there's a family involved of multi-generational folks. And often there's a lot of sort of meat on the bone, as it were, when it comes to growth and value creation. And understanding why is actually pretty basic, right? Not to get too in the weeds, but I love this. Like I eat and sleep this stuff. I really enjoy having a captive audience. You guys can't leave for a little while, so we're going to talk about this.
Facts.
But you think totally hypothetical numbers, so don't draw or add too much weight to it. But say I own an HVAC company. We're doing air conditioning repair, whatever. It was my dad's company. We've been in business for 40 years. And I make $1 million a year, or the company does, and I get the benefit of most of that, whatever, semantics. And I've never hired a great marketing firm. I don't have a sense of what my digital strategy is. I'm only in the market I grew up in. I've only been hiring from my family, so maybe my human capital is not super best in class, maybe. The challenge with that situation becomes that guy, that gal, they're in a great spot. They're making $1 million a year running an HVAC company. This is awesome. And their company's probably worth a whole bunch too, right? Because it happens to be a popular industry in this example. But to get that company to grow from $1 million worth of sort of benefit to their owner, or EBITDA as we typically look at it, to get that to go from 1 million to 2 million, that's a capital intensive process, right? Doubling the profit of a company that over 40 years has not been able to double for whatever reason, intention, mechanics, capital, whatever, some reason they have not done it yet. Mm-hmm. And likely either have not been interested in doing it, or they can't actually do it, right? They don't have the talent, the roadmap, the vision, whatever. Mm-hmm. So that owner is going to have to defer making that $1 million for probably, again, made up, but somewhat realistic example, for 3, 5, 7 years to double that profitability, right? And in between then, they're going to be going to zero or to half in order to double their profits.
You mean because they're going to be putting that money back into the business?
Exactly.
Their personal income's going to go down.
Exactly.
So the company profit can go up.
And so most sellers, I think of them as sellers, most business owners look at that and just go, that's not interesting to me. Why would I go to the mat to maybe double my sales or double my income or EBITDA, whatever, when we've never been able to do it before? And that's kind of the moment that middle market private equity, this down market private equity for these smaller businesses, can really add a lot of value and step in and say, let's de-risk you, whether that's buying them out completely or giving them the capital they need to grow and maybe some of the expertise they need to grow, some of the human talent they need to grow, and exponentially impacting that concept of them deferring some of their income, right? Instead, you get a bunch of chips off the table, you get a whole new reinvigorated team, and we sprint to grow. And that growth sprint is usually done in the context of a mid or near term exit, right? Capturing that unrealized value, and then ultimately selling that hopefully better company, more profitable, larger, more professionalized company to a larger upmarket buyer.
So if I could kind of just summarize that for you. So you're searching for things that you believe have value that have yet to been discovered or actualized or whatever verb we want to call it. And you buy that asset and you infuse capital, time, energy over a discrete time period so you can sell it at a multiple for more that you bought it for.
Yeah, it's that easy.
And it's always selling. It's
Why don't we
not
just do
like,
that, Chris?
Well, to me, like, I think, what's the difference then between a VC and a PE?
The stage in which they enter the capital stack, right? Venture is early stage. It's usually sort of pre-meaningful traction, right? I mean, there's VCs that enter into the process at all kinds of different points, right? We have our angels and our dad's dentist friends as the very, very tip of that spear, right? The guys who are paying for
Friends,
proof of concept.
family, and fools.
Exactly. And then you have, Andreessen on the other side, right?
Yeah.
Or whatever, a mega, a large VC firm that is still investing in earlier stage companies with massive growth opportunity. Private equity is kind of the boring version of that. It's not boring to me, but I think the outside in, it's a de-risked company because it's not new. In fact, it's a company that's probably been around for a very long time.
You would argue being new is a red flag.
Yeah,
Not
in this
data.
context,
Yeah.
through the lens of a risk versus upside kind of conversation.
Financial formula.
Yeah.
Exactly. And most institutional or large investors are going to have a footprint of both, right? They're going to be doing some small betting on some early stage. They're going to do some little bit more meaningful betting on some late stage private equity stuff. They may also get into growth equity, which is actually the connecting tissue, right? So venture exists on the left hand of the spectrum, very new, very risk, very unproven. Private equity exists on the very right hand of the spectrum, de-risked, predictable, track record, modest upside opportunity, but commensurate to the risk, makes sense. And in between is that growth equity conversation. Those are firms that typically are investing in a non-control capacity. So they're not buying companies. They're not buying control of companies. But they're meaningfully capitalizing companies that are either starting to do this or have been hitting that ceiling. And capital is the thing that's constraining them from really realizing that next iteration of the business.
So the difference between those two is like the expertise that's offered or guidance that a PE does, and then the growth is just like, here's money, go do your thing.
Yeah, I don't want to disparage the VC world, mostly because I don't know enough about it. I've done some early stage investing, not in an institutional capacity, but in a meaningful capacity to myself. And it does seem like it's mostly capital for capital's sake. Again, clearly not a critique, but just a reality, my observation. And that's okay. But the return rates are what they are in the venture world. It's a very unlikely outcome to get a huge win.
Yeah.
And there's certainly all kinds of exceptions to that rule, but most people don't make a lot of money in the VC world. Conversely, on the private equity side, the success rates are very, very high. Of course, the upside is much more modest, right? VCs may want to minimally 10x their money. A private equity firm might minimally want to 2x their money in a similar time frame. But speaking from my own experience, in the PE world, the capital component is really important, certainly, but it's so much more involved. It's equal parts people and capital and probably strategy. And, we're fairly small. We're spinning up our second fund right now as this current iteration of the team.
How many people?
We are 4 general partners, but we employ 600 people or something right now.
Wow. 600 people.
yeah.
So what are all those 600? Are those the companies?
Yeah, those are the companies. Those are all the
Wow.
people at the operating level.
Yeah. That's a lot to oversee for just 4 people.
Well, thankfully, we have a great executive team. And it's fairly common now in private equity to inject what we call operating partners into the process. So I think most of us envision the height of the pyramid in a corporate context as a CEO, maybe a board who holds the CEO accountable. And that's certainly the case. But we utilize operating partners as the connecting tissue from the fund, from the managers of the fund to the operating company, because oftentimes those CEOs, they really know their industry. Usually they're old dogs from that industry who've really proven themselves and are looking for one big, big opportunity, at least in our case. And they don't always understand intimately the context in which a private equity firm is going to be making these asks and putting them through these exercises. And for us, having operating partners do some of that coaching, some of that de-risking, some of that babysitting, dare I say it, with the operating team is really, really valuable. So we mostly interact with our operating partners and our key executives. But to my point, unlike VC, we interact with that team a couple times a week, not once a quarter. And again, we're fairly unique. We work in a little bit different of a structure and time cadence, but we are up these folks' butts and they're up ours, right? We all have a side of the bargain to uphold, and it's a pretty engaged conversation. And I would say, although we talk about our earnings a lot, we talk about our sales, we talk about our EBITDA, certainly, we don't talk about the deployment of capital that much in the context of companies we already own, right? We really are talking about people all the time. Is this the right butt in the right seat? What does the team that can manage a $200 million company look like in comparison to a team that can run a $50 million company, right? There's some real fundamental differences in those people, and we're very involved in that conversation.
And that's the day-to-day of your job as a...
It's all, I mean, we could split the role into a few things, right? We're always looking for companies to buy, to acquire. That's its own process. You're doing outreach, you're talking to sellers, you're doing financial analysis, and we have some team members, of course, that support that. But the other side, I guess there's two other sides to this three-sided coin. One is looking for acquisitions. The other is blocking and tackling with your investors, with your limited partners. We have a dedicated role that handles that, our head of investor relations, but I know he spends a lot of time just Q&A and developing relationships and answering questions. And then the third side of that coin is really that people and ops conversation. You can't just buy good companies and hope they stay good through a transition, especially when it's a family-owned business or it's been closely held for, I mean, we've bought companies that are, 40, 50 years old. There's a meaningful cultural challenge there. All kinds of, sometimes it's a technology challenge. Sometimes it's, sometimes it can be these really basic roadblocks, that create more friction than you'd think, right? The Arizona branch doesn't want to use the digital time cards. I mean, we get into that, right? It's we can laugh about it here, but I don't usually laugh about it. But
I get it.
But go make them,
Mutiny,
right?
Mutiny.
Yeah, 100%.
It just seems like that's a nearly infinite number of challenges that a group of 4 individuals, obviously you have your operating partners and other people to support, but it just seems like so challenging to look at all these companies at various stages of growth and capabilities and be like, hey, this is what's going to help you grow to this number that we have. And then this is going to help you.
Yeah, you're not wrong. I mean, I talk to a lot of folks, usually through, social internet channels, about that challenge. How do we get our arms or heads around all of these moving parts? And there's some best practices from a system standpoint. There's some good technology that helps, obviously. But often in the conversation, I get to this place where I sort of am now known for really stressing this idea that I used to think, I think a lot of people, younger people in our industry, think this is 80% science, maybe a little dusting of art. It's mostly, how to build the LBO, how to find the capital. There's an ecosystem
what's
for that.
LBO?
Like the leverage buyout model, right? You know how to build some mechanical model in Excel or whatever. And that's most of it. And that's all mission critical stuff. But I'm kind of the mind now that this is 60% art. And I know a lot of people will disagree with me, and they likely have more experience. And
it depends on the asset class too.
100%.
The smaller you get down that lower middle market, that Main Street
becomes more art.
Way more people. When you're $1 billion tier 1 private equity, it's
that's
this is what
mostly
Excel
science.
spreadsheets. Exactly.
Yeah, totally. But in the middle market, our ill-defined middle market,
what's fun though. It's what, there's millions of those.
But it's the art piece is an interesting challenge, right? I mean, I think we're all in some capacity artists here, whether it's in that capacity or in, the medium we're engaging with right now. But it feels a lot more manageable to engage with an artistic endeavor of that scale than a technical one for me.
100%. Yeah.
Right. I feel like it's probably not dissimilar to any large creative project. You're writing and directing a movie, you're recording and writing an album. Those are really innocuous, vague, conceptual things. But it also comes with a certain level of freedom to sort of extract what you need to produce those things.
Intuition.
Exactly. And I'm more comfortable there. Again, I'm not claiming that's a better strategy by any means, but I'm way more comfortable saying, you know what, model be damned or Excel spreadsheet be damned. I think I see something here.
Yeah.
And when we have those 10,000 checklist items, especially when you buy a company, right? We have an integration roadmap that we execute, of course, when we're combining companies, and it is many hundreds of items long. Tactical stuff, right? Transferring the truck fleet into your new entity's name, rebinding the insurance. Changing the phone numbers on the business card, whatever.
I mean, I bought a house. I can imagine how complicated buying a business is.
Yeah. So there, we
like,
have
geez.
like 400 tactical items that have to get through in even a small landscaping company, right? And that seems really daunting to me. It's thankfully not my responsibility. We have a professional, and she manages that. She's our VP of integration, and that's where she lives. But I can sort of abstract from that thematically what we need to do, where we need to go, and that's the art part for me.
I'd like to take a kind of pause here and just reflect on why I think intuition is so important in your atypical career path. Allows you to use more of your intuition because you're coming at this from more of a subject matter expertise.
Sure.
And you've collected more, let's call it metadata through these human interactions. It's not always easy to articulate or refine, but there's something that your intuition can tell you about. And like betting on your gut is good when you're an expert in your space, because you can't always find out why you have a good feeling about that, but there's something that has your subconsciousness is like elbowing you like, hey, this is a good deal. Take that opportunity.
I think Blink is right there.
Yep, there you go. Exactly.
I do want to take a little vocabulary lesson, ask some sophomore questions.
Please.
I'm asking for Chris because he doesn't know. What is EBITDA? Or EBITDA?
Earnings before interest, taxes, depreciation, and amortization, right? It's a financial metric that normalizes the income of a business after you remove a bunch of items that have a impact to a profit and loss statement that are usually non-cash based. That's an even more technical answer, but it really, down market, you'll hear net income, right? Just what the company makes. Somewhere up from that, you'll hear the term SDE, seller discretionary earnings, or SDI, seller discretionary income. That's sort of like what the owner keeps out of that net income, right? Because your net income is going to be subject to tax and all kinds of maybe reinvestment in the business. So the SDE is sort of what does that gal get to take away from that business? And then as we move larger, we get into that EBITDA conversation. And I mean, without giving you too many dry examples, you can think that, a company, if we were to buy your company, Anthony's selling his company, we're buying it. Our tax structure is going to be different than yours. The way we apply debt to the business and therefore amortize is going to be different. So we just take all those things that are non-core to the business and we remove them. And then we look at what's left as sort of a standard model for a business without any of the trappings of ownership discretion as it impacts financials, right? And that becomes sort of the number that we usually apply a multiple to, right? When you hear, I sold my company for 10x, that's usually either 10x revenue if you're in the tech space or in the startup space, or 10x EBITDA if you're in the PE space. And if it's 10x in the PE space, you're probably in a pretty hot
and what's the difference between revenue and EBITDA?
I mean, revenue is what comes into the top of the funnel. EBITDA is what's left at the bottom, right? And
is there a difference between profit and EBITDA?
I mean, it depends on what type of profit we're talking about, right? There's gross profit, which is, just what's left over after your direct costs. Profit's a bit less technical, I think. You could talk about penny profit, which I talk about a lot. That's, you sell the stick of gum, how many pennies are left over for you, right? It's a really granular perspective on sort of itemizing a big enterprise into what's the penny profit of the thing. We talk about that a lot in auto manufacturing, right? There's a lot of good coverage on what manufacturers make per car, right? And there's these huge discrepancies. Yeah, right. Like Porsche is hugely profitable per car, even though they're less expensive than Ferrari, right? They do a lot less marketing than Ferrari does. They don't have an F1 team, right? So a lot of different ways to look at profit. Profit's a little vague for us.
I want to know, for anybody listening to this who's, say, a 22-year-old kid who's like, I want to do what you do. Could you tell us your story, how you went from this diesel mechanic shop to where you are today?
Will the mic hit, or will the mic pick up me hitting my head against this?
Oh, well, yeah, go get at it.
There you go. This is how you do it.
beating your head against something.
Yes.
Yeah.
Until it bleeds.
For those listening,
Yes.
he was knocking his head on the microphone.
That's how you do it. No, I think I always tell people, this is not sidestepping the question, and I'll share a little more color on the background. But at the end of the day, you have to be an expert in something. And I don't care what that is, right? Somewhere in the world, there is some guy, some gal who, is the consultant you hire if you want to make a tube sock. And she's the most prolific tube sock engineering mass production coordinator ever. Insert title, right? But I think that the takeaway from the example is just that expertise is what drives upward mobility in career arcs, right? It's less about I'm going to be an analyst and then an associate, or I'm going to be a junior attorney and then I'm going to have my own firm, or the assistant manager to the man. It's not about that. It's about, can you confidently enter a market and differentiate yourself as an expert? And if so, you can do anything, right? You can design products, you can consult, you can invest because you have some proprietary intel over what makes that great product. Very vague example, but it comes down to, what are you, Mr. 22-year-old guy, going to be an expert in, and how are you going to become expert? For me, that expertise is probably a little more on the side of operating middle market, again, however we want to define that, businesses, right? I try, and you guys are helping me do this today, but it's tricky because people say, what do you do? You're at a cocktail party. You say, oh, I'm partners in a private equity fund. And that kind of calls a certain background, archetype, storyline that is not at all consistent with mine.
Just so the audience knows, in my mind, I'm thinking white guy who went to Harvard, lives in New York, worked on Wall Street. And
So
then,
Dad worked at a hedge fund.
yes.
yeah,
So
got
we,
money from
Mom was
family.
in finance.
we call him, this is a really funny story, actually, as fun aside. We call that guy Chip from Wharton.
Nice.
And
Oh, you
from
know
Wharton.
Chip?
Yeah, I know Chip. I'll tell you a funny story about Chip in a sec. And that's not a dig on anybody who went to Wharton, phenomenal school. Anybody named Chip, cool name. It's an archetype, right? And we know what that is. Funny aside,
He's got a vest.
he has a vest for sure. Funny aside, we just hired a new associate at our firm. Awesome guy. Sourced him from Reddit. We've sourced LPs from Reddit. We've sourced associates from Reddit. Really,
Specifically the private equity subreddit.
yes. Shout out private equity
Not
subreddit.
on like the
Are
main
you
news
a
feed.
mod on that subreddit?
I've been
Don't
pending being a
do
mod
it.
for
Not
like
worth it,
6
man.
months, and they can't figure their shit out. But it's okay.
But you're
I got
just like
I got other stuff to
a
do.
frequent contributor.
Yes. And so we hired this associate, awesome guy, and we had a little company camping trip last weekend, and we were all hanging around the fire, and I guess he's been with us maybe 2 months.
It's a culture interview.
Yes. And we had this moment where he kind of was in confessional mode. It's midnight or in the desert, and he says, guys, I don't know if I should never tell you this or tell you now so it's not weird later. And we're going, oh no, what's going on? And he goes, my dad, and I've never talked to him about his family, right? He runs a private equity fund. And we go, okay, integrity move. You didn't lead with that. You didn't use him to get to us. Like, we love this. You're doing it yourself. Yeah. And his name, it's Chip. And we've been running around the office going, fuck, Chip, all that. Oh, and we all were and it worked out. It was an embarrassing moment for us. And no hate to any Chips, especially this one.
Yeah.
He's
Makes
got
it
an
even
awesome
better,
son
though.
who's making our team better.
Yes.
But that archetype, back to your question, is not something I identify with a lot. What I've done is start and run businesses, right, and ultimately sell them as a seller, not as a private equity professional. So I joined my first sort of we'll call it a startup right out of school. I'd actually left school to join the startup and went back a couple years later.
Where did you go to school?
USD. And we had an opportunity early on to build a actually kind of private equity attractive business in that it was boring. It had predictable contractual revenue. It was not subject to big consumer trends or technological trends. It was a food, what we call co-packing company, right? Which means you take a product that somebody else has made in their kitchen or factory and you finish it and you pack it. And in our case, we were finishing with chocolate. So that might just be, we did a lot of meringue cookies once upon a time, and the meringue manufacturer would ship you in bulk all these little meringue cookies, and we would put a chocolate bottom on them and then package them for them, right? Very boring, classic kind of private equity business. You would get contracts based on hundreds of thousands of pounds or millions of pounds of goods that need to be finished. It wasn't a consumer at a checkout stand, paying $4 for a candy bar or whatever. And that company grew fairly quickly. It was a tremendously chaotic experience, not in a bad way, but just tremendously chaotic, like classic startup vibe.
Was this started with like fellow students at SC?
No, so this was actually, it's a funny story. The founder I met while I was selling shoes in the mall. And I sold her a bunch of shoes. We kind of hit it off. She was an experienced or older entrepreneur. Her and her husband had started this company. It was pivoting to this co-packing model at the time. And we joined, and the company got acquired like 22 months later or something.
Wow.
So nice. It was a chaotic but interesting.
So you had your first
run.
exit within 22 months.
Yeah, I was like 22 or 23, something like that.
Wow. Impressive.
Which is really interesting. It's a mixed blessing though, right? There's some upside. There's some resume bolstering, but you also don't know anything, right? I mean, that would be like becoming I don't want to overinflate the analogy, but you're the president when you're 22. It's like, so what do you do when you're 26?
Yeah.
You don't really know how to do anything other than be the president.
Yeah.
Right. And there's only one of those. So
small tangent. There was some guy who went out to the Olympics, won a medal, and then came back to wrestle in NCAA. So what do you do after the Olympics?
Exactly.
Like, well, you just keep wrestling.
You just keep wrestling.
It's like, what else is there to do?
Exactly. So there was a little bit of that. I didn't have a tremendous amount of expertise, but I had a interesting experience in the context of a positive outcome that was hyper-growth chaos. And I translated that into some consulting in a hyper-growth chaos context, right? Working with not usually startups, but companies that were really starting to scale and needed a certain level of professionalism and also just prep to be acquired, right? There's a certain archetype of business that gets acquired from a system standpoint, from an HR standpoint, compliance, financials. A lot of businesses, even good-sized businesses, are not that well professionalized. Yeah. Most of them focus really hard on delivering a great service or product, which is step one for sure. You can't really do one without the other, but often the other gets neglected. So we did a bunch of interesting consulting, but eventually ended up working with a family investor. You might call them a family office, but a family who was investing in operating companies, and they had bought a commercial office furniture distributor and ultimately a chair manufacturer and some other things. Calling back to my comment earlier, like some private equity fund owns not just the company that built this chair, but probably the company that builds the wheels on the chairs for all the chairs that are in every studio everywhere in the world, right? We never think about that, but we're sitting on 4 gel casters that are probably owned by a private equity fund. We did that kind of stuff. And we bought some companies, we built some companies out of that brand. And I really got to see what the professionalization process of a legacy older business looks like. The first business we bought while I was working there was at the time like a 30, 40-year-old company that had 30, 40-year-old culture and technology.
Tech stack.
Yeah, and I mean, talk about tech stack. This was like in 2000 and, 5 or 4 or something like that. So the whole, just getting onto like spinning up a server instance in the warehouse was a big deal, right? And we did.
T1 server shout out.
Yeah, 100%. So I lived through that, and that was kind of my first taste at quasi-private equity. It was smart capital, buying businesses, adding value, professionalizing them. It was also my first peek at what awesome leadership could be, what I think a healthy team environment could be in the context of driving that kind of performance, right? It's a different animal to hire somebody and say, answer the customer support tickets versus you're going to answer the customer support tickets and we're all going to be working together to triple in size this year. And that means something different on the day-to-day to that guy answering those support tickets. So we had some ambitious goals within the confines of some classically structured older businesses. And I really got to learn about an interesting management dynamic that I still think a lot about. I won't call out my awesome manager by name, only because without the right context, this might be viewed as a criticism, and I don't intend it to be that way. But the MD of that company was really, really good at simultaneously making me know I wasn't good enough every day, and also empowering me to be better tomorrow, because I wanted him, that guy, not the culture. I wanted that guy to know that I could get there. And I know that can sound kind of abusive. That was not my perspective at all.
I beat people up
the push
I
and
want
pull.
them to be better.
Exactly. There was a little bit of that. And I don't directly manage people like that specifically, but it was an inspirational moment to really learn that there could be really painful challenges, but really meaningful support and tools for me to grow and learn, but also a hardcore accountability metric and matrix that was infallible, and that we would really engage openly with what does that look like? Mm-hmm. And we would make decisions driven by that data in real time that were sort of unafraid. It was a transformational experience for me, but it was a lot of work. And frankly, I was probably a little underqualified. I became the CFO of the company. Every time you buy a company, whether it's a distressed situation, worthless company, right? Worthless, not the right word, but a value impacted company, or a really great, sexy, healthy company, you pay some investment banker a whole bunch of money, and he doesn't seem like he does a lot. I can say that because I used to be an investment banker. We'll get there. So pretty quickly I said, well, I'm getting paid X. These investment bankers I interact with once or twice a week are getting paid X times 10. I'll just go become an investment banker. I know what a good deal looks like now. I mean, so I thought, right? And ultimately I became an investment banker, got licensed, worked at an investment bank here in Southern California. And
just quickly, how's it different than a regular bank?
Investment banks, well, it depends on the type of investment bank, but we were primarily in mergers and acquisitions. So we were mostly helping business owners of larger businesses sell to private equity funds.
And you can't open up an account in an investment bank. You can't go take a mortgage from an investment bank. That's a retail bank?
Yeah, yes and no. I mean, there are large banks that do both. Goldman is a great example. There's been some legislation over the years after 2008 that prohibit investment banks to take custody of like deposits of people's money. There's some potential conflicts there that we've all lived through over the years. But no, investment banks primarily exist to do deals, to manage transactions, high value transactions that are one-off, and that typically only happen once in the life cycle of the client, right? Not all of us, not many of us sell a business more than once or twice in our lives. It's kind of like getting married or whatever, right? It's you don't usually do it that many times, maybe 4 times. Right?
Investment bankers are like wedding DJs.
Exactly. Investment bankers are literally wedding DJs.
Just the worst.
No, just kidding. No, shout out to all the investment bankers I love out there. But I became an investment banker because I just thought it was a lower path of resistance to some higher income potential, which I believe it was. For me, a lot of my decisions are kind of driven by some fundamental why questions. I think that's not unique to me, but I really sit with my why a lot. And at the time, my why was it was a money thing. I've always been interested in entrepreneurship. I remember writing what do you want to be when you grow up report in 4th grade and learning that obscure French word. Still can't spell it. Thankfully, Siri can spell it for me. But so I've always been really interested in like income maximization. And of course, the irony becomes once you have some critical mass with income, you realize it's all made up and a fallacy and you don't care anymore, right? I'm pretty detached from income now, but philosophically. But while trying to maximize my income at that investment bank, I learned how terribly inefficient investment banks run in the background. The process of getting a company ready to sell, documenting it and auditing it and creating the marketing materials and what we call making a market, right? Finding enough buyers to start bidding on this obscure company that nobody's heard of is a pretty inefficient process. And it only took me about, maybe 2 years, maybe less, before I kind of said, I'd rather fix these problems that I've become expert in than apply the solution. And I remember, I think I had to quit 3 times because they didn't want me to quit, and maybe I wasn't that clear on what I was trying to do. But eventually I quit and eventually poached our director of research, who is still to this day one of my business partners. Phenomenal dude. This was 16 years ago. And I started one of the first back office fulfillment firms in the investment banking world. A company called CapTarget, still exists today. It's a different business now. It primarily serves private equity funds in helping them source companies to acquire. But that started all those years ago. So that became sort of my 2.0 entrepreneurship iteration, my adult entrepreneurship, because by then I was an adult, whatever, I was 26, 8, something, I don't know. But through that process, we built a little company, self-funded it. We started with $4,000, right? We went to Bank of America with our little checks, and we went all in with what we had. And through that, we ended up spinning out the first verticalized full-service digital marketing agency in the private equity space, a company called Merger Labs, which was acquired in 2018. We spun out what is now a merchant bank called GP Partners, which started as what we call a buy-side firm in the private equity world. And CapTarget still exists today. I'm technically the CEO, but we have a great team that manages most of the day-to-day. Through that process, we interacted with a bunch of private equity funds. And there was an element at some point in that learning process where I kind of just said, I think I have all the pieces here. I have a company that generates the deal flow that big firms are paying for. I have this merchant bank that's finding off-market deals and monetizing them. We have a digital agency that is bolstering the perception of these firms online. And I have a bunch of operating experience because I've run a bunch of these companies. A couple of them have been acquired by some private equity-like buyers, right? So the only thing I didn't have was, $100 million or whatever. But that's easy. It's actually not. But that got me to a place where I started looking at how, my why changed at that point. And my why became built around understanding what is the biggest game I can play. And it's different than asking what's the biggest game there is. Because I don't think I'm equipped to play that game, however you want to define that, whatever. It's being the CEO of Goldman or an F1 driver, whatever the big game is. This was an interpersonal exploration of me with my capabilities, my skill set, education, experience. What do I think the biggest game I can play is? And for me, that was founding a middle market private equity firm, right? I think in that sort of $50 to $500 million deployment space, we had some interesting competitive advantages, both in how we find deals and how we look at how sellers think and feel. And now when we approach potential business sellers, I like to tell the story that I've sat on all sides of the table, right? I've been the startup entrepreneur. I've been the second employee at the startup. I've been the second employee who exited the startup. I've consulted on the companies that are growing rapidly, racing towards the exit. I've been the CFO of the company buying those companies. I've been the banker on the other side of the table advocating for the seller as they interact with those private equity firms. Ultimately, through my work at CapTarget, we've worked with thousands of private equity firms and really gotten a sense of best practices, right? Talk about being an expert in something. I think I've become expert in sort of how to run a lean, focused, fairly small private equity firm, which is a really niche thing, but that is where my expertise lies. So within the context of my expertise, the question became, how big of a thing can this be? And we raised our first fund a couple of years ago. We're largely done deploying that now. Our second fund is being spun up right now in a different space, and a third one's right behind it. And I think we're hitting a really, really nice stride in trying to play the biggest game our little founding team thinks they can play. Hopefully we'll be proven right.
Could you tell us, you don't have to, the size of those funds?
Yeah, first fund was $50 million. which is tiny in the context of private equity.
And how big were your initial investments out of this 50 million fund?
I mean, the first check we wrote was like $12 million or something. It'll end up being, 7 or 8 investments, something like that, fairly small. We're mostly buying, Fund 1 was dedicated solely to commercial landscaping. And most of them are sort of like $5 million revenue little companies that with $1 million of EBITDA that we're combining into one bigger company.
Are you rolling them up?
We are rolling them up. So we have a pretty productized approach. We actually basically just do roll-ups, right? So we are looking for price inefficiency, right? We're looking for the opportunity to say, hey, Anthony, your company today, your your $5 million landscaping company is worth whatever, insert number, 4 times EBITDA, some number. A lot of X factors there, so don't hold me to that. But if you're part of my organization that's 10 times larger than yours, you're going to be worth the same as a division of a big company instead of a little disparate company, right? So all of a sudden, your company goes from being worth 4 times to maybe 13 times. That doesn't actually happen in a day. On paper, it can, right? You can quite literally say, look, today your company's worth $5 million. Tomorrow your company's worth $18 million. It just matters who owns it and what they're doing with it. So it is a roll-up. Everything we do is a roll-up, all based on arbitraging the EBITDA multiples and values of these companies as they go from small to mid-size.
Yep.
Could you break that down real quick?
Yeah.
Really simple. So roll up, taking a small company, put $5 million in your mind, company, much larger company, and you're saying if your value is X amount, is 20 million, 4X that. Like if you integrate into this larger company, your value becomes bigger than that. And what is the advantage of that?
Well, that's where you make the money.
How do you make the money though? Because you said it's just on paper, right?
Well, you got to sell the company eventually, right? And you got to integrate the companies. I mean, to the extent you have there's some different strategies, but ultimately you got to integrate the companies and professionalize the companies. But there's a whole ecosystem for us of buyers, private equity buyers, mostly some strategic buyers. So those are just your competition, your big competition, who for all kinds of reasons can't write really small checks in their mind, right? So if you have $1 billion private equity fund, which is still not a huge one, but it's a meaningful size, it's going to be too expensive for you to write a $10 million check. The diligence costs too much, legal costs too much, your process is too heavy. Again, not a critique, just a reality. They're tooled to do big deals really, really well. They're not tooled to do ghetto little tiny deals like we're tooled to do. Super ghetto, super tiny, super weird, right? So if you can bring them an investment that meets their criteria, that is of critical mass, they will pay a premium for it, right? So we sort of build to spec, as it were. When we start buying companies, we already know who's going to buy us, and we know generally what they're going to pay. And we're doing the dirty work they don't want to do, right? We are combining enough companies to get them $10 or $20 million worth of EBITDA, which might be a $100, $200 million revenue company, which they view as the starting point. We view as the ending point. So we're all part of this interesting ecosystem of sort of...
There's always a bigger fish.
There's always a bigger fish. There's always a faster car. There's always a bigger fund. And we just play in this space where we want to serve up to larger funds, high quality assets that they can pay a premium for.
And I think I can answer your question with some extra detail about value creation. And what we were learning earlier from Gabe is that he's looking for companies that happen to be profitable inefficiently.
In spite.
And so the idea is like, well, if you've made this much money and you suck at doing it, imagine how much money you could make if you did it optimally. And that's where you're getting into value creation. So I do want to take a little step back and talk maybe an analogy earlier about the difference between VC and private equity. And if you think of a roulette table, like VC's betting in. They're betting the 1 through 36. PE's betting like red or black.
Yes.
Like odd or even.
Yeah.
And then they kind of have a sense if it's going to be red or black because they've done a lot of due diligence. They've looked at the marketing. It's just like way more of a skill.
Yep.
And I think PE also tries to have an active hand. Obviously, this depends on the asset class. If you're doing billion-dollar deals and like you're merging AT&T and some other conglomerate, you're not like putting people in there. But especially this asset class, you're like dealing with the operators, you're dealing with the owners, you're meeting multiple times a week. Like I've been and raised VC money and like I send quarterly updates. Like
Yeah.
every year, like make sure they get their K1. Like that was the relationship with the VC, unless I like needed something or an intro. And private equity is like you're along for the ride. That really changes some things. And I think, kind of if we run through the asset class to just give us a formulation, because we've learned a ton, I just kind of want to summarize.
Of course.
So if you think of public markets, that's one option, public equities. Everything else is private equity. And so it's a big catch-all. It's colloquial. Technically, venture capital is private equity. It's a subset of private equity. There's different asset classes. And so when people use the word PE, or when they say, oh, PE's owning the world, or PE's doing this, there isn't some conspiracy theory. They don't all meet together. Like Gabe doesn't know KKR's CEO. They don't have a WhatsApp group. It's like, hey, Gabe, how are we screwing over the American economy together today? What's our plan? Like they're just, I consider them cowboys. They're just out there trying to make their capitalistic cowboys, doing it on their own. They're out in the frontier. Venture capital stands for adventure capital because it was so adventurous. It was like not appropriate in a risk tolerance. When you have like an undefined risk beta, that's venture capital. When you can't even assign a number to it because it's so damn risky. Given all that information, like you have your angels, you have your VCs, you have your private equity, and you have like Main Street, lower market, mid market, tier one. Can you talk us about the architecture of a firm, a fund, who gets paid, how the money flows to where, how a GP makes money, how you make money off of a deal? Is that a salary you're making money? Are there like payouts? Are those rolled up to the firm? And not you specifically, but just in general, how does a GP partner make money at the firm? And just give us a little 101 of like a firm architecture org chart.
So my partner, John, likes to say this to LPs as a joke. We take your money and our experience and turn it into our money and your experience, which is not far off, although I know where he's going with that. But so, again, a lot of diversity depending on the structure and asset class. But most private equity funds earn fees in two ways. In a management fee context, which is not dissimilar to when you have a mutual fund through your Merrill Lynch guy and he charges you 2 points or whatever to manage the thing, right? That's our management fee. Most private equity firm management fees around 2%, yes, of the deployed capital, which is an important note that we'll come back to. And then the big carrot is carried interest. And that is a meaningful, usually around 20% take of all the profits generated by the fund. After the investors have received their principal and usually a preferred return of some kind back. We call that the 2 and 20 split. That's sort of where you make your money. But most private equity firms, especially smaller ones like us, we are our largest investors, right? Which is why you have to be an expert first, because if you're going to make enough money to start a fund, you're going to need to have been expert in something to have made enough money, right? So we are some of our largest investors as a group. And that means we also make money just as a normal limited partner would, right? Our money gets invested and the cost basis is X and it gets sold for X plus plus and we keep the difference. And we don't pay management fee or carried interest on that, which is actually accretive to really, really nice gains. Because if you can invest in private equity and you have no cost basis, your returns can often be a turn or two of MOIC, which we can get to if we need to.
Multiple on invested capital.
Yeah. A turn or two of MOIC higher. So the 2 and 20 split is kind of the core. There's a lot of different ways to structure private equity funds right now, but ours are sort of classic, what we call commingled funds, which means there is I'll describe the corporate org chart to you.
Thank you.
Get real exciting here. Let me describe, picture this, a bunch of boxes on a whiteboard. So no, you have typically the fund vehicle, the commingled funds is a limited partnership entity that exists. It's managed by a management company we call Manco. Manco is where the GP, the general partners, sort of live, the managers of the invested of the cash. That cash gets invested down below that limited partnership into some sort of holding company or opco of some kind. And that owns all the businesses that you buy. It's a funny little pyramid with a little tag off to the side. That's the classical structure of a sort of boring private equity fund. Now we're seeing the advent of a lot of independent sponsors, fundless sponsors, SPVs, SPACs, right? There's a bunch of different ways to do all these, to buy a company.
Special purpose acquisition company.
Yeah. SPACs kind of had a moment, and a lot of shit happened, and now it's
Stop trying to make SPAC happen. SPAC's never
not
going to happen.
I mean, shout out to whatever grift Trump was running in that moment, where isn't like Trump Media a SPAC run by like two teenagers in Florida?
Not a political podcast.
Well, good for them if they did it. That's all I'm saying. But all these alternative structures look and feel a little bit different, but all ultimately have a manager who's being paid to deploy capital, which is important, right? So you don't get paid to sit on somebody's capital, right? So Anthony gives me $100 million. I don't charge him $2 million for giving me custody of that $100 million.
Scared money don't make money.
Exactly. You got to deploy that capital to charge a fee. So there's an interesting incentive there, because I'm incented heavily to write checks with Anthony's money. The balance to that incentive is, if I write a bunch of checks inappropriately, I don't get my carry, and my management fee is only 10% of the value of, or not even of my carry, whatever. It's
more importantly, you don't get another fund.
And you don't get another fund.
So.
Exactly.
Dead to me.
So there's this self-balancing economic incentive between deploying capital and deploying the right capital and getting the right outcomes that kind of keeps everybody honest. And then, there's some other fees and earning opportunities that exist. Often private equity funds will close a deal and charge some sort of transaction fee, or maybe they source the deal and they get a finder's fee. There's a bunch of different angles that you can attack there. But at the end of the day, there's a pool of capital from a bunch of investors that is managed by a separate entity of general partners who get paid when we deploy capital and paid when we create a liquidity event for everybody, which is usually happens between a 5 and 7 year time frame. Verde runs a little different. We sort of sprint for 3-year outcomes, which is a whole other animal. But that basically means you write a check today, you're not going to see any return for at least 3 years. And then you'll see a preferred return that gets paid to you first. That's usually a small, it's 6, 8, 10%, going to just sort of help de-risk the investment. And then everything above that hurdle gets split up in that 2 and 20 kind of context.
And that illiquidity is typically why you get higher returns, because you're assuming more risk for not having access to your money, as opposed to a public equity, which has immediate liquidity that you can sell at any moment at any time.
Yeah, you can't, with few exceptions, in a classically structured private equity fund, you can't call the manager and say, hey, we're going to buy a house. Yeah. And I know we're up.
Get that money back.
We're up 200% from our last audit. I'd love 200% of my money now. There is a secondary or tertiary market that exists to buy and sell those kind of things, but they're at huge discounts. So if you want to get out of your private equity position, you might be looking at a buyer of your equity that will pay you 30 cents on the dollar or something. It's not a good outcome typically.
How much or how many returns, or have you had returns, sales, since you started this fund?
No. So as this group in this fund context, no. But that's because we work in it's not a single purpose vehicle, but we work in a single purpose kind of context, meaning there are private equity funds that are diversified, right? They will buy 10 companies in 10 different industries. Maybe they're complementary. Maybe it's
beer and pizza.
Yeah, beer and pizza, exactly. But it's not the Beer and Pizza Co., right? It's two brands that have some similar dynamics that support their success. We only buy a single type of company per fund vehicle, basically. Doesn't mean technically it means it's one big company because it's all owned by one holdco, but often it's disparate brands that are owned by a single company. So there are plenty of private equity firms that are diversified that can sell one asset. They're going to sell beer today, but they're not going to sell pizza because pizza is going to have its moment next year. We don't have that flexibility. We sell all of it or we sell none of it. And we look to sell all of it about every 3 years. With Fund 1, that would be at the end of next year. But you always are concurrently spinning up a new fund, both to maintain some momentum and just to capture opportunity that comes across your desk, right? You really don't want to sleep on that.
I do want to go to a little vocabulary lesson, but I want to throw another detail. Most VC funds tend to have like a 10-year time horizon. Most private equity is like 5 to 7. Given his asset class of being like lower mid-market, he's at 3. especially as an emerging manager, he's also incentivized to produce good juiced up numbers for fund one so you can go raise fund two.
Yep.
Because this, the whole point of fund one is to raise fund two. And if you have a very myopic, accelerated, like, oh, I know exactly what I'm doing, I'm going to go get some easy wins immediately, then you have some credibility, you can go get larger institutional investors. So I do want to have like a speed round of just general glossary.
Hit me.
LBO.
Leverage buyout.
Okay, what is that?
Well, it's usually when we talk about LBO, it's usually in the context of the model that informs the transaction, the financial model.
What are you leveraging, and what is the buyout?
Yeah, so leverage buyouts are acquiring companies largely with debt, right? Not 100% typically. Somebody else's debt. OPP debt.
Other people's money.
OPM debt.
Shout out
I
to
am.
you, DeVito.
I'm also down with OPP.
Oh,
so
yeah, you know me.
You know me. But so tough. So leveraged buyouts really involve a third-party lender giving you access to debt to acquire a company, usually based on some sort of combination of the asset value of that company and the cash flow of that company.
So you want to buy something, you can't afford it, so you assume debt so that you can't afford it, and so you've leveraged this buyout by taking on debt.
Well, and the affordability piece, it's a funny way of putting it, and I know we're kind of speaking in layman's terms, so it's not incorrect, but it usually has more to do with return on equity.
Yeah, exactly. Because
Right.
you're trying to juice the numbers in the
Yeah,
back
you're
of
trying
the
to juice
IRR.
the numbers.
We're going to
Exactly.
get there.
Okay.
IRR, what is it?
Does this come from this debt? Does this come via a loan from an investment bank?
It usually comes from private credit. So funds that exist to loan money to
Alternative
private
assets.
equity funds.
Yeah.
Debt funds.
So if you don't want to invest in stock, you can invest in credits or
Which are
alternative
awesome.
assets. And private credit, it's like a whole industry. And this is basically saying like, hey, yeah, you need some money. We do some deals. It's like a loan shark, just professional and regulated.
Yeah, but like our fund one loan shark for the whatever, I don't know the exact amount of equity we raised to the dollar, but they will show up and say, hey, we've earmarked $45 million for you of line of credit or of credit facility that you can draw as long as it meets certain criteria, right? And then
Loan covenants.
Yeah, loan covenants, which are the bane of everybody's existence always.
Yeah.
But ours are fair and it's fine. But we always think about loan covenants. But it's a great way to both juice the numbers and buy assets that are bigger than the check your equity ask can write.
Yeah, I like it. And how do you MOIC money at a PE firm? What is MOIC?
MOIC's that raw return.
Yeah.
MOIC doesn't consider time, right? So there are two.
And what is MOIC? Explain it out for me.
The multiple on investing cash is really the raw return on your dollars. Again, not considering time, right? So if you invested $1 million in a fund and you made $3 million, meaning you received $4 million back, right? Your principal plus 3, that's a 3 MOIC, right? It's also a 300% return, but MOIC's easier to say than 300%. I don't know, it sounds cool.
Yep.
But it doesn't consider time, which is important because time is reflected by IRR, right?
Yeah.
Which stands for what?
The internal rate of return, right? Which is there's a T in the middle of that equation, right? So that considers time. So let's just go through the thought exercise. So I've got an investment, whatever, and I'm going to make you 5x your money. It's some great number, 5x your money. But it takes 50 years. And I've got an investment that's going to make you 2x your money in 5 years. The IRR on the latter investment is going to be probably hundreds of percentage points higher than the 5x your money in 50 years. Because the longer you're in an investment, illiquid, I mean, there's a time cost of money, there's opportunity cost, there's further perceived risk. I mean, this isn't a super popular sentiment, but much like human beings with finite lifespans, at least in our spacesuit things that we're trapped in, every day you don't die, the risk of you dying tomorrow goes up. And eventually, there is a near 100% chance that tomorrow you will die, right? Hopefully that you're very old and you've lived this full life, but that's the reality. Businesses are the same, right? I mean, there will be a day, I don't know if it's in 10 years or in 10,000 years, where we will laugh and say, you used Google? What an idiot.
Yeah.
Like, you used Facebook? I mean, I've never used Facebook, sorry, but
Good for you.
yeah, I'm only somewhat anonymous on Reddit, and I don't need more exposure than that.
Yeah.
I don't like being monetized. I have no issue with social media, but I don't like to make some other guy rich based on abusing my mental state. I think it's gross. But the time factor is really, really important, right? We want to think that if you have a business that you need to hold for 50 years, which there are evergreen funds now, funds that don't have a expiration date, that really tout themselves as being de-risked because they don't have to sell at a certain point in time, right? So if the market conditions are bad, they don't have to sell. And we don't have to either, but there's some pressures and there's some governance requirements that incentivize us to sell. But the counter to that becomes, if your business doesn't go out of business in 50 years, the chances of it going out of business in the next 50 have to be a little bit higher. And I don't know what that looks like. I'm sure it's very case by case and nobody actually does that math. But conceptually, it's a good thing to think about when we think about MOIC versus IRR.
And I have another nuance for you about VC and PE. A VC typically has no agency and authority over a liquidity event. And so they cannot compel their portfolio companies to exit so they can return money to their LPs. However, if you're an LP in a 5-year private equity fund and that person running that fund says, hey, I could sell your company for 10x today, or if you wait one more year, I could sell it for 15x. There is some agency, like when the sale is and what price you sell it at. And so the PE wants to have bigger returns, but these LPs have some handcuffs of like when they need to get money back. And you said you were going to give me the money and I only needed to get 8x. So like I don't really need 15x. And so there's just a lot more, I guess, involvement of PE in the actual transaction, where VC is really like, well, I put my chips down. Like I hope they make it. If not, I'm just going to keep betting more.
Yeah, we're living through that right now with our first fund. We have an opportunity to exit a little bit early that is seemingly pretty attractive. And pretty quickly you start doing the math of what do you pick up holding for another year or two, considering risk, considering some unknowns, considering some of the macro forces at play. And in this case, we've not made any decisions. It's very early. But we look really hard at some of those dynamics. Is it better to sell today and know that we're meeting the expectation and fully de-risked and have captured track record and can roll into the next fund, et cetera?
What's important, fund two.
Exactly. Or do we want to go for the pure profit play and hold for that extra 30% of return, knowing that there's going to be more than 30% excess risk on capturing that return? And we're actually going to, I think, have a pretty spirited discussion about that tomorrow. So it's always, in a PE context, there's often those opportunities that don't exist in the VC world.
Yeah, that's not even on their perspective.
No.
I want to know more about what you said earlier when you're talking about your philosophy of money, of saying it's fake and what you've learned. I assume from saying that is a bit of a humble brag of, hey, I made a lot of money. I don't need to really think about it so much, or I see it in a different way.
I do see it in a different way. And
I did not mean that in a negative or pejorative way in any way.
It's ironic that it always happens that way. It doesn't always happen. In American culture, it's probably the most common way to sort of get to money detachment. But you can go all around this awesome place where money is not, and consumerism isn't part of our core culture, where people are detached from it and they have some food and they have some family and they have a roof and they live a great life. So I think you can get to it a couple different ways. We don't exist in that environment, so it's not really easy to just sort of be the broke guy who doesn't care about money in this gnarly system that we've built. They're trying to build a prison. But
what do you mean by that?
Just quoting system because we're up here.
Yeah.
Let's get into it.
I mean,
this is a safe space.
Is it?
And despite what he said,
we recorded.
Not
a safe space.
No, but despite what Anthony said about this not being a political podcast, there's no bad opinions here.
No, sure. I mean, I think, there is obviously capitalism in a broad sense has created more opportunity and prosperity for more human beings than any other system we've developed here.
Yeah, we're living in
this planet.
The healthiest time, most prosperous time in human history.
But I think us not challenging our thinking about what could be next is really short-sighted.
You mean in terms of like some type of social financial system?
Yeah, just what our whole deal is going to be next time around, or
Especially when the robots are doing all the work.
Yeah, I mean, look,
the AI agents and the drones are doing all the, half of the jobs.
Yeah.
It's like, well, something's got to shift because
Totally.
the taxes are only going to the equity, the owner equity, people who made those robots.
Well, and look, we live in a physical environment and a sort of construct model that is entirely predicated on unlimited growth in a finite environment.
Yeah, I know.
That doesn't work forever. It might work for a long time. Technology might get us, it might work for thousands of more years, but fundamentally this
Hell, it
idea
doesn't.
that, yeah, I know. But,
Yeah.
but let's give them credit, whatever.
Yeah.
What you said earlier was so kind of hit me as it shouldn't have hit me, but the idea of looking at the life of a business is just like a human, that inevitably you are going to die. It's going to be over. That is not the kind of, I guess the analogy to human life is we don't ever think about death. We act like we're never going to die. And it's the
think
exact
about
same
it
with
every day.
capitalism and business.
Sure. And we should think about our capitalistic death, or it likely won't be a death. It'll be a evolution, hopefully, some sort of transformation. But I am not citing who wrote this, but I will poorly quote it. I mean, we just need to go through the thought exercise of like, there was some time when the world was dominated by slavery as a source of labor, right? I'm not talking about America 300 years ago, but like the world 10,000 years ago, right? It's Egypt, it's Mayan culture, it's whatever, right? We had this weird slavery situation going on, and some great thinkers in that moment were going, this is awesome. These people, they're not really people. They don't cost any money. You barely have to feed them. What a great model. And then somebody came along with feudalism, right? Said, look, these people, they're getting a little ornery. We're going to give them a place, but they got to pay us rent. But now they have some autonomy.
They were the progressive at the time.
Yeah, it was very progressive. And everybody said, this is great. It's slaves, but they're not going to chop our heads off. This is awesome. And we, of course, iterated on that. But I feel like there's a real pushback, probably because it's very profitable for us to live in this consumeristic, sort of pure capitalistic environment, where it's really, there's some real disincentives to talk about what could be next. And so, I make no claim, I don't know
Or how to make it better.
Or
Yeah, no, I agree.
no claims there at all. But I just think, much like this life cycle of a business or a human, we need to look at the life cycle of our model and say, every time a different iteration of this has existed, all the power centers said this was the best version it could ever be.
Yeah, right.
And something meaningfully disruptive had to occur in order to just get us to think about what the next thing would be. And I'm really interested in what that might look like. Again, with no idea what I am not the right person to make that call.
I think, as the cost of energy continues to go down, the economy of what that means is just going to shift so greatly. We have all the energy we need by the sun. We just don't capture it and deliver it appropriately.
I capture a bunch of
as
it.
technology is improving, as we have, a new space economy, and this kind of creates just a new way to exist, things are just going to shift. I think, the technology and the AI agents, all of this underwritten with, I'm going to go on a tangent here. 2025 is the year of quantum. And I know we haven't talked about it here. Our podcast has very little to do with quantum. But there is new stuff that is coming that is going to disrupt society at such a rapid pace. The rate of technology is only going to continue and improve. So just to date myself here, I went to high school before the iPhone came out. So
I went to high school before, so
yeah,
no,
right.
there were some cell phones. They were big.
I didn't have a world with smartphones, and I've been around. The whole world has changed with smartphones. How people exist, how children interact with adults,
So
how
much
humans
more.
interact with each other, how kids date, how people. And I was like, geez, that was just in my lifetime. So imagine when quantum computing comes out and we have the ability to just scale and rapidly grow, the rate of technology change from the beginning of the millennia. We've only been a quarter century, right? So 25 years. I've lived that, and I got to experience dial-up internet. We were joking about T1 servers earlier, up to agentic AI, and now we're starting to have a new hardware that's only going to increase that rate of technology. And so if you look back at the past quarter century and you extrapolate a more aggressive rate of innovation for the next quarter century, that's going to displace the economy and the human labor input and how people have jobs. It's we won't have a choice because the disruptors, the innovators, the entrepreneurs are going to make drones and automation and robotics. They're going to take people's jobs, and those people are going to need to have some other source of income. Think of truck drivers, classic example.
Yep.
We're not too far away with like, why do we need a person driving that big truck? The truck drives itself. There are millions and millions of truck drivers in America. What, are you going to send them back to school? You're going to give them UBI? Are you going to demonize them and tell them that they're lazy and they should go get jobs? Are you going to tax people so that we can re-educate and redeploy them? Are they going to clean the robots so they become robot mechanics?
Yep.
And so like something's got to happen. It's going to change. And I don't know what's right or wrong, but it's just an objective truth that it's happening, and it's going to happen quicker and faster.
Maybe we'll all just have imperial credits instead of dollars.
Nice.
Who's to say?
I like it.
But back to your question. I mean, not that there's an answer, but I mean, I think it's good for us in a non-flippant way to own the idea that money is a construct. Doesn't mean it's not valuable. Doesn't mean it's not moving mountains for everybody right now, and we all need it. I don't want to devalue that at all, but it is a thing we all just decided was going to be the expression of value for our output. And just owning that gives us some flexibility about how we can think about it, right?
Yeah.
I mean, we could take that a step further and probably make some claims about the broader construct. I mean, if this is us collapsing a wave function a whole bunch, we've got a tremendous amount of power to define and influence what will be now and in the future. And I think there's a lot of incentives to keep people from meaningfully exploring what that power looks like in mass.
Yeah, 100%.
It took several hundred years for Rome to fall.
Yeah. Didn't happen overnight.
Yeah, and I think that I want to now kind of ask, because you were saying that you were driven by a why, and you said that your why in the beginning was making money,
Just
and
dollars.
then it was, what's the biggest version that I can, the biggest game that I can play in. So now what is your why?
I mean, I don't know how this practically gets expressed, but before Stephen Hawking died, there was some great Netflix show, and he had this awesome intro with his awesome voice, that synthesized voice that we've all both made fun of and probably thought was really cool. Like, I wish I could be like a robot Superman sometimes, right? And again, butchering whatever the little lead in to the intro of the Netflix show was, but
Which show was it?
it was whatever last show he made before he passed away. But in the intro, he talks about, the fact that he's been confined to this wheelchair forever, whatever, for most of his adult life. And the outro, line from him is, "But in my mind, I'm free," right? And he might have been one of those freest people who was actually the most imprisoned in his body. And I'm really interested in what that could look like for the rest of us. What does being free in my mind look like, And I don't know. I think a lot about it a lot.
Yeah,
I think
especially
about
now,
it a lot. Yeah,
when all
especially
of
now.
our held truths are just constantly being dispelled.
Totally.
UFOs, aliens.
I've seen some weird shit.
IRS.
We've all seen some weird shit. Yeah, totally.
My friend who is a pilot for Netflix showed me a video, because I'm on TikTok.
Like a
and-
commercial pilot or a movie pilot?
No, he is a commercial pilot for Netflix's private fleet.
Cool.
That was very confusing.
And-
Now I
and,
understand.
Yeah, sorry. And he showed me his own video over North Dakota, unidentified flying objects, and like I'd seen them third hand on the phone.
Yeah, but just
or
because
wherever.
you don't identify them, they're definitely terrestrial objects from Earth.
Well, by
No,
definition, they're
humans.
here, so
Yes,
they're
unidentified to you. Identified.
There was
to the
no
military.
propellant, like there was no propulsion system that could drive this in the way that it was moving. And anyways, so then they have all the drones and all that stuff. So yes, back to your point, 100% everything is being questioned now, and the freedom of the mind, I feel, could be that next evolution part of it.
Yeah.
Obviously.
I mean, I think
Necessitated.
in a professional context, the U.S. has been really good about asking what's next and leading the curve on innovation for quite a while, in all kinds of applications. And I think we need to keep asking that, right? But I think the what's next exploration is now going to be more about the model, more about the context in which we interact with and exist with that model, than maybe what's the next technology. Because I mean, if we do get to a AGI singularity point or whatever in the near future, I imagine our need for technical innovation will be drastically reduced. And I don't know if that means we all become artists. I'd like to think we're all artists already. Maybe we can have the time and bandwidth to express that a little more meaningfully, but it's going to have a crazy impact. And I'm just trying to level set around like, how much should I care about this construct of money when I know everything's going to change and it's already made up anyway. And again, that's not to say we're not super aligned in meeting our goals and really passionate about the work we do, but it's good to explore what's next and how we can contextualize what that's going to look like within our own construct.
How do you hold both of those at the same time?
I'm just in constant conflict. I just sit in the shower with my arms against the wall going, I mean, you know, it's always something new. But it's not a bad thing. I mean, it's there might be some sort of fundamental outcome that is the marriage of technology and organic life, right? I'm not like a transfuturist or anything. I don't know much about any of that, but maybe that's the point of this whole thing. Maybe it's to capture the two sides of this intelligence and integrate it, and maybe this whole thing is trying to know itself, and those are the two extremes of output.
Have you ever read *Sapiens*?
No.
*Sapiens* is a great book. He had a follow book called *Homo Deus*.
But that was like the OG of that topic, right?
The OG was Guns, Germs, and Steel.
Yeah, which is amazing.
And then the follow up was *Sapiens*, and this individual, this author, I believe he has a PhD, talks about
UCLA.
Homo sapiens as
and Jared Diamond.
There you go. Excellent. Perfect. Yeah. Shout out. They talk and write about humans as a species, and they're anthropologists like studying that species, and it just talks about hundreds of thousands of years ago, tens of thousands of years ago, thousands, hundreds. And then Homo Deus is like, well, what comes next if you continue to extrapolate that? And they just talk about the merging of like, oh yeah, humans are just going to invent stuff so they can put computers in their body.
Yeah.
And like Homo sapiens as a species, we are ending our evolutionary track, where the new track, Homo Deus, were people who have chips and sensors and Neuralink. It's just like, oh yeah, no, they've had that since they're born. They're no longer a human species. If you were an alien, you came and you evaluated humans, you're like, oh yeah, no, around here, 2021, that's where they start to split, and all the new babies start to get them. Then they do it in pregnancy. Then they found out how to do it in the sperm, and then then they got the robots in the womb, and so it's integrated in the brain as the brain's growing. Like, you can just imagine if we were trying to reverse engineer how we get hardware into people, you just do it earlier and earlier. So they're just like, you're no longer producing humans. So to me, that's not a matter of when or if, but when, like sometime to the future,
Sure.
some subset of Homo sapiens, and you'll have your Mennonites who never do that and don't do that, like electronics, and the Mormons will get on their spaceship and go have their own, Mormon planet.
They've been waiting for that.
Yeah, so like, if you've ever seen The Expanse, the Mormons are a big funder of like interplanetary stuff because they want to be Mormons in other planets. So like, I still think we'll just have religious people, we'll still have humans, and like, it'll just create more diversity. That's a healthy thing for a species. Interplanetary travel, having diversity, having different evolutionary tracks. Like, maybe the tech people don't make it because they get a virus.
Yeah.
Yeah, a double entente on the virus.
Yeah. I think though, back to the a question that was asked long ago, more of a tactical question about how do we get our heads around all this work that has to be done in our professional context to integrate a company, to buy, professionalize a bunch of companies at once, to manage all this. I think it's good to compare that task to the tasks we just talked about. What does this evolutionary task look like? How painful is that going to be? Or wonderful? I don't know. But it makes answering 50 emails a day way easier. It's not that important, right? I mean, certainly our outcomes are important, but in the grand scheme of things, there's a precedent for how to do that, right? There's a playbook for how to buy a company. We did not invent it at all. I mean, by no means will we ever make that claim. The unknown stuff is the stuff that's going to be painful and wonderful, and it makes all the rest of this sort of just a tactics exercise, which is fine. We all have to do something. I'm a big believer in our broad social contract. I want to contribute to this thing, whether it's from a tax basis or beyond standpoint, and that's really important. So whenever I'm 300 emails deep or whatever in a day, I view it through that lens of, this is my contribution to the thing. And the thing is changing, and I need to be really aware of how that contribution is going to change.
did not expect our conversation to go.
I know,
go
it got weird.
Yeah, no, it's
I like
great.
it, I like
it's
it.
great.
This is all I think about.
Do you have like a meditation or like a yoga or kind of like a
Yeah.
spiritual practice?
I mean, this is not a spiritual practice. It's again more tactical, but I am a big gateway tapes guy.
Nice.
Remote viewing session
Monroe.
starts on Friday, Saturday, Sunday. I will be in the class,
Nice.
which is awesome.
Is this through the Monroe Institute? Wow, I just found the tapes.
My dad has them reel to reel. He's a big audiophile.
So you've had
and
them for a while.
So funny story.
This
That
is crazy, man.
Totally off topic,
Yeah.
and we can just
Our first podcast.
throw it in the bin.
Gosh, get a podcast,
I tried to
guys.
tell him about the tapes and binaural. He already knew about binaural, but I was just trying to
You
tell
listen to
him.
them at nighttime or something? Sleep?
Whenever you want.
Oh, okay.
No, you don't. The first sort of level of meditative relaxation in the context of the Monroe Institute is called Focus 10. There's just different levels of focus.
Yeah.
But Focus 10 is all about you have your body fully asleep, but your mind is fully awake, which is a weird feeling.
Yeah.
It's not relaxed. It's your body's asleep. And
Yeah.
you're sitting there going, what's going on? But totally tangential story. But when I was really young, my parents are both kind of boomer era hippies, in their late 70s now.
Are you Latino?
Yeah. My half my family's from Tijuana. The rest are San Diegans. But
Hola, señor.
sí, claro.
Simón.
Way, okay. We got the guy in LA, East LA here,
Yeah.
East Los.
Chicanos represent,
Yeah. Listen, we can talk about Tres Puntos later and Who Dusted Spider. But, as a little kid, my parents were kind of on that side of the spectrum.
Yeah.
And I remember I used to listen to a cassette tape that was like a kid's relaxation, very 1980 situation, right? And it would help me sleep. It was just really beautiful, just little kids, story. And years later, I tried to find it. And it turned out it was this almost who knows where they probably got it from somebody at a yoga retreat who was dubbing tapes for their kid, something very obscure. And I couldn't find it for years. Eventually found a physical copy of it from a lady who I had to send a check to, whatever. It was very analog, early day internet. I found this copy of the tape. And I wore it out. I bought a Walkman, put batteries in it so I could listen to it and sleep as an adult listening to, Macaroni Pony. And years later, it became available online. I found the same lady. I looked her up in my inbox, found her, wrote her, hey, did you ever digitize this? And I didn't make the connection at the time that they were not digitizing it for some reason. And the woman interacted with me. It was great. And I ended up Googling her name just to see who's this old gal who's curating these funny children's relaxation tapes from 40 years ago. She was a Monroe Institute person, and it was like a kid's gateway tape situation. And nobody told me. I've been listening to it since I was 3.
Wow.
Wild. And when I only found that out maybe 3 or 4 years ago, and I had this moment where head in hand, oh my God, this is
This
a
whole
full
time?
This whole time.
So was this a kind of a subversive isn't the right word, but kind of a discrete kind of introduction to binaural through storytelling?
I think so.
But then was there any, because so much of it is directed through his voice, but it's storytelling. So
Yes.
was it storytelling, empowering storytelling, implying hey, you can control your world with your thoughts?
No, it was more, I think probably more on the kind of relaxation side than the activation side. But funny, I joke with some friends now, and all these years later, there's 2 sides to that tape. I don't know what the first side that I always listen to, how long it is. I've never heard the end of the story. Never. I don't know what happens to Macaroni Pony. No idea. This guy, he seems like a nice guy. He's going to the market. He's got his buddies. I have no idea what happens when they get to the market because I've never stayed awake through the whole thing. But it's because the cadence of the talking discreetly slows to the point where near the end, I've woken up near the end, and it's a word every 2 minutes.
Wow.
And I think that has something to do with both the relaxation side, but also the focus side, because as a little kid learning language, you now have to string, these are no longer and the next to each other. It's and 2 minutes of introspection And that's a very different way to engage with spoken word and with language. So it probably is a little bit of a back door. But now I'm gateway tapes for life, so I'm in deep.
Wow.
Which is
so
awesome.
Cool.
And I mean, it sounds so cheesy, and I know this is not the topic of the day, but when I think about sort of detaching myself from maybe a conversation about earning money exclusively, again, everybody's got to make a living, not poo-pooing that, but just not making that the core central thesis to like why I wake up in the morning.
Yeah.
Our truths are changing and being disrupted and challenged so much, which is a good thing. It's an evolutionary thing. And the other day, somebody was really pressing me on Reddit about like, well, what do you actually know about any of whatever?
On
right?
Reddit?
Yeah, on Reddit. Same place you press me. And I thought about it for a while. I probably took 2 days to write the guy back, and I wrote him back and said, the only thing I'm sure of is that I am not this thing, right? I don't know I don't know the what or the why, but I know that this isn't the full picture for me.
Step 3 in the preparation.
Of course, I am more than my body.
Yeah.
And I am, I know it. I know I've experienced all kinds of wild things, but that helps me take a step away from the pure play of this business model.
So we're getting into now, first episode, we're getting into what I see as like the kind of heart of entrepreneurship, and that's mindset.
Totally.
It's 100% mindset.
Totally.
Not to say, and like I wrote this, so I still remember I wrote it. It was like a thing I wrote on my Instagram after I finished shooting my movie, because I had worked my whole life trying to like make a movie. Not my whole life, my whole like adult life, young adult life. And the secret hit me. I was in the bathtub, I remember, and I was like, what? I was like so proud. We had like worked really hard to shoot at this giant festival with like 100,000 people. And it was all like, it was the finishing scene for the movie. So we had like all these like 100,000 extras for free, something we never could have afforded to create for our low budget movie. And when I was in the bathtub afterwards, just been thinking, I was like, oh, what can I write inspirational? I was like, oh, the secret to success is never giving up. And it that sounds trite, but it's so fucking true.
So true. We get in the context of private equity. When we started raising our first fund, it was sort of by all definition the worst time to raise capital like ever. Maybe 1924 was worse or something, right? But basically that level. And we got a lot of questioning about, why are you doing this now? You guys don't need to do this now. You could wait 2 years, or you could have done it 2 years ago, whatever. And our response was always really clearly, someone has to do the work. This is important work. In the context of the U.S. economy, it's important work. Private equity employs something crazy like high double-digit percentage of the U.S. workforce. And so we really viewed it through this lens of, this is our act of service. Somebody has to do this every day. If you stop doing it when things get difficult, you're really not in the game. And we had to look beyond sort of the short-term challenges and have a mindset of both, this is valid work to do, so we believe in it, and we believe that there's a clear and probable path to success, right? We're not in the full boat of like, we can do anything, whatever. We try to contextualize that a little bit too, to the current circumstance or whatever. But we can still look at it fairly objectively and say, the roadmap exists, a lot of the conditions exist, a lot of our talent is apparent. This seems like a highly probable outcome based on what we know, and somebody has to do it, so why not us? So beyond the mindset, I do think there is a audacity to try component that's just...
What's the why?
You show
up.
up.
Back to that.
Yep.
It's tying some purpose to what you'd also mentioned of purpose, not only to you individually, but some purpose to something much larger than like the matrix of money, capitalism, politics, all the nonsense that we're constantly bombarded with, that I am more than my physical body. I'm connected to something deeper. Therefore, I'm here for a purpose. And my purpose may be within the matrix.
Totally.
But like, what keeps that grounded is that connection to something more.
100%.
And that's what drives too.
Yeah. Well, and, I mean, to bring this back to a kind of pure business perspective, just like there's always a faster car, and I know because I have a lot of fast cars, and none of them are ever going to be the fastest one, there's always a guy with more money. In a private equity context, there's always a bigger fund. So when you're acquiring companies, you cannot be, I don't believe a sustainable strategy for small funds is just being the guy who pays the most. So you have to connect with something beyond the pure money play, whether it's becoming a really good culture picker, a really good people picker, a really good storyteller who can attract those sellers who have some shared values and vision with you that actually matters a lot in the context of your financial performance ultimately. It can't just be who writes the biggest check. That's a race to the bottom or to the top, whatever, but it's a race to an extreme finite outcome that's probably not the best. So we always try to lead with, in fact, we've been having a discussion over these last few weeks, my partners and I, really reorienting around a values conversation that's not values for a website, but really when we send an offer, the spirit of that offer needs to be anchored to these things. And we need to be able to communicate that both for strategic reasons, so they don't just look at the dollars. And when they're reviewing with their husband or their wife or their lawyer, they can say, you know what, this is the second best offer, but these guys seem to believe in something that I believe in. And there seems to be a modality here that is attractive to me, or whether it's just being sort of perceived as counter to the standard private equity guy, which there's, being a contrarian is a nice, easy way to get some attention, right? It's a good model for that exists everywhere in our waking lives now.
We're not Chip.
Yeah, exactly. We're not Chip. Oh, believe me, we have some cocktail glasses in the office that have some words about Chip on them.
Nice.
Chip from Wharton
that we drink about. Yeah, you know Chip. Shout out to Chip, by the way. Chip's fucking awesome. Chip's probably living the life I wish I could have lived 20 years ago, but I'm really happy with the one I'm living now. So hopefully Chip is happy.
A stripper's ass.
Exactly.
In Miami.
That's no longer my goal. It might have been for a minute, but it's not my goal now. But there is a through line to that why and to those values, again, beyond the corporate exercise, that I think can create positive outcomes in a deal context. Because we can't just be writing the biggest check and seeing where the LBO model breaks.
Yeah. Exactly. And I think, in my experience coming on let's call it the beginning of this asset class, early stage venture, we're like, oh, I have an idea. Like, cool. Everyone's got an idea.
Yeah.
It's all about your ability to execute.
I don't care about your idea.
Yeah. No one cares. No one's going to steal your idea. You can talk about it. It's probably dumb idea anyways. Yeah. But one of the biggest underlying factors I see over successful founders, because I meet a lot of founders, being the moderator of Entrepreneur and growing that over the past 10 years, I constantly see the people who come through, and I can kind of quickly size up individuals who lack intrinsic motivation.
Yeah.
I see a lot of startup pitches. I always talk about what Socrates teaches us, these three modalities of persuasions. You have your ethos, your ethos, your credibility. Do you have a PhD? Do you have a degree? Are you black belt in Six Sigma? Like, what are your formal credentials? What gives you credibility?
Yeah.
You have the logos, or the logical explanation of the quid pro quo. Like, I'm selling my owner's equity for X, you're buying it for Y, and Z is going to be higher than X. The pathos is really where I see the determining factor of long-term success. And the pathos is your passion. Why are you intrinsically motivated to solve this problem? And the individuals who are motivated because they want to make money, sometimes they find success. But what I've noticed is when they meet failure, they're the first to quit to go find easier money.
Yeah.
Because their objective was to make money.
Yeah.
And if this pathway is arduous, why would they take that path when there's another lateral path? The opportunity cost is lower to achieve the same outcome.
Yeah.
But if you're launching a biotech drug discovery company because your brother died from the disease that you're investigating, you're probably not going to sell out at that first pass. You're probably going to work a little bit harder. You're going to send that extra email. You're going to show up on that Saturday morning to open up the lab when you didn't want to and you could have slept in. Like, there are things you're going to do that are bigger than yourself, that are bigger than the company. It's an intrinsic motivator. And if I had to assign any attribute, it's individuals who have the grit and determination with an underlying intrinsic motivator that will compel them to do something that an individual who's more money voted just simply won't.
Yeah.
Well, I think a lot of that grit and motivation can be tied back to some sort of experience of meaningful pain.
Trauma bonding, you know?
Yeah, I mean, well, however we want to define it, I think I generally like working with people that are unafraid of pain because they've experienced a lot of it, right?
Yeah.
It could be physical, it could be emotional, it could just be getting beaten up in an industry where it's hard and you get told no a lot or whatever. I mean, this is the land of being told no a lot, LA. For most people, it's why I leave. It's too painful. But I have a lot of respect and like attraction to team members who've lived through pain because they tend to be more motivated and they tend to be unafraid, right? I mean, hopefully this doesn't skew my perspective on risk. I don't think it does too much, but I have had nothing. So if I have nothing again, it's not a step back from how I was, and that was fine.
It's like a checkpoint in a video game.
Yeah,
Like, I've been here.
it's fine.
I've played this level.
But being unafraid to have nothing is really freeing, because then if you have something, you really celebrate it, you really value it, you're really interested in what it takes to get that something. And that only comes from just experiencing some nothingness or some pain at some point, and then you have a real benchmark. I don't really, with few exceptions, really like fundamentally respect or am interested in people who sort of just show up and have not lived through the pain, whether that's because of pre-existing wealth or nepotism or in interest or whatever. I'm not saying they're not going to do a good job. I'm not saying they're not worthy of the work. Just my opinion of them, which is probably just a flaw of my own. These are, I'm sure, plenty of wonderful people, but I look at those guys and go, you don't got it, and you don't even know what it is.
Yeah.
And it's kind of off-putting.
Shout out to Dr. Becky Kennedy here. I'm going to channel some of my early childhood development knowledge. Since I'm a recent father, and I've been reading about toddlers. She has
Dr.
this
Becky,
philosophy.
that's
Dr.
the
Becky
Instagram
Kennedy.
like kid.
Totally.
If you're a mom or a new dad, I'm sure your wife is
Yeah.
informing you as much as I am. Shout out to my wife for helping me stay a better person. She talks about this learning space, and to go from unknowing to knowing, you need to enter the learning space. And the learning space is the place of frustration. And the emotions that you feel within the learning space are frustration. And the only way you can learn is to be frustrated. If you are not frustrated, you are not actually learning.
Well, then I must be learning every day.
And so this learning space allows you to build something called frustration tolerance, or what she refers to as frustration tolerance. And that is where I have seen people who have a high degree of frustration tolerance have been through trauma. And individuals who've only found success in their life have low frustration tolerance. And when there is something outside of their control that affects and causes a negative outcome, they don't know what the hell to do. They're the ones who are in therapy. They're the ones who are breaking. They're the ones who have mental episodes like, you've never been laid off before, man? Like, you've never gotten a B? Like, you've never been punched in the face? And you can tell some people who've never been punched in the face before. It's like real clear. It's like, oh, yeah, I can tell how you're talking. Like, you've never been hit.
Yeah. I've been punched in the face.
You know what I mean? Because
like, I punched a couple people in the face.
It's like some people, it's like, oh, you've clearly not been in this world.
Yeah.
And I think in a professional capacity, you often see people who have low frustration tolerance and they don't deal well with mistakes and errors. It's like, oh, you're just not cut out for this lifestyle. That's okay. If you want to be a quant and do things perfectly, like go be an accountant where everything has to balance on the credits and the debits and it's got to match. Like if that's your phenotype and persona, that's your career path. Maybe a huge risk tolerance to unknown with undefined risk betas isn't an appropriate lifestyle. Someone who likes perfect balance of things to always match up. Yeah. And so another caveat is to like know yourself. It's okay to not want to do this, to not want to play Shark Tank. It's not fun. It's not glorious. And I think a lot of people talk about the upside without acknowledging the amount of failures. And as a failed founder, as someone who's blown millions and millions of dollars and has sunk costs and had nothing to show for it, I try to encourage people to like stick with their day job. This isn't for everyone and you shouldn't pursue it. And like, if you're not in private equity now, you're never going to be. I think the most common question on the PE thread is, how do I get into PE? And like, oh, you don't. That's
and I say, look at my sticky.
Like, if you're here, like the answer is you're never going to make it. But the easiest answer is you make people money. Like just a quick catch-all. How do you get private equity? You make my
second answer after read the sticky. It's just go make a guy money.
Go make someone money. And then objectively, you're in private equity. It's like you're professional when you're paid to be somewhere, and you're professional when you're paid to do something. And so you can do it if you make money.
Well, on that note, we have a sort of new-ish hire who's in what we would call a value creation role. those are the guys that just look for opportunity, right? Usually now through a tech lens.
Is that a full-time job
Yeah.
with your firm?
And this guy, awesome guy, talk about how do you get into private equity. Unbeknownst to me, he'd been trying to get a hold of me for like months. I get a lot of inbound, and my days are sometimes really just pretty overwhelming, and I don't, admittedly, I'm not super on top of it with new, out of context inbound that comes to me, but I try to get to everybody. And he, through the time I was ignoring him, somehow connected with like everybody else, one of our operating partners, a guy who works for my other company. He met all these people.
My favorite way to get a hold of someone.
Totally.
No other friends.
And so eventually all of these people on our team said, hey, have you met Oz, right? Shout out Oz. Awesome guy. And I said no. And eventually we ended up having lunch together. And he basically said, I want to be in private equity, and like I'm just laying at the feet of the private equity gods around town and just seeing what happens. And I told him the same thing. I said, well, if you can make me some money, you're going to have a job, but you got to make me some money first. And I don't know what that looks like for you, but also a new dad, also a guy who just left a big corporate job that he was unhappy with. And the company we sort of deployed him on that has been around for 15 years and has not been growing, grew 30% last quarter. And all of a sudden, he's in every meeting that we have. He's going to the trade shows. He's coming along to he
proved his weight.
He's proved his weight.
What were some of the things he did?
I mean, again, a lot of these companies are old companies.
So just
Stop
introduce
faxing.
Yeah, no,
introduce
just
a Slack
digital
channel.
low-hanging
email.
fruit. Yeah, I mean,
30% Slack channel.
in his case, it was like a lot of marketing automation, a lot of like internal process automation, better documentation, better training, and also just having a human capital resource, a guy in that role who's not me, who's not an executive with maybe a broader mandate, who can really focus in and spend time with individual employees and just say, all I want to do is understand your pain.
Yeah.
That's all he does. He goes around and just says, what doesn't work here?
Yeah.
And grade your pain, and let's talk about it. And then he presents solutions within the context of a budget and says, hey, these are the big pain points. Let's start smoothing them out. And if you do that constantly, eventually I think you get really good outcomes. We're just at the very inception of that, and it's already been really, really positive. But it was a great real world example of go make me money.
I need to bring Oz into my company.
Yeah, Oz is awesome.
You got any
I'll
extra
connect you.
Oz's?
No, but Oz can do some other stuff.
Nice.
I support Oz's ability to grow his career. He's an awesome guy. So when you end up with this, how do I get into the space? There's an element of like, if you have to ask ... right? Which is a dick answer.
Totally.
But it's kind of,
You can't even read the stickies.
Hey, I thought you said you didn't like the nose in LA. Now you're bringing it to San Diego.
Well, that's why it's an open-ended observation. But, I mean, it reminds me very much of probably late 70s Steve Martin stand-up. And he had this whole bit about how to become a millionaire. And he really like cues it up, right? It's like supposed to be like a comedy seminar. Everybody have their notepad, he's really leaning into it. And
he's very genius. He's like,
Toby Robinson.
it was basically,
very Tony Robinson.
It was like Steve Martin and Dave Chappelle.
Totally. And so everybody's, waiting with bated breath. And he goes, okay, How to Become a Millionaire by Steve Martin. And he goes, okay, everybody get your pencils out. Step 1, have $1 million. And everybody just falls out of the chair, right? But man, yes, right?
It's the easiest way.
It's the easiest way for sure. And I hearken that back to the how to get into PE context sometime. And it took me a long time. I was in the peripheries for a long time and some alternative versions of what we're doing now. But there's an element of the way we got into private equity in this current iteration as principals was we had to have enough money to start a fund if nobody else supported us.
Yeah.
Right? Which is not a humble brag, but is a reality that at some point, if you want to get in, you either have to be on the track from day one or you have to buy your way in.
Yeah.
And there's plenty of ways to buy your way in, but again, that comes full circle back to, but if you're an expert in something, your chances of being able to buy yourself into that next level of investment and management that happens at the top of all industries, whether it's private equity or just institutional investors of some other kind, it's going to come with capital that's derived from expertise.
Yep.
Otherwise, if you're Chip, you're going to be hazed for 20 years. And you're going to be getting paid well while you get hazed. And your life's the reason we see so many posts that
Analyst,
say,
associate.
what's my life like in PE?
Uh-huh.
And people write back, and I just
Go look at financial careers
trite
and just
jokes,
look
but-
at those numbers. Like, yeah, you get high earnings, but like you're a miserable human.
yeah.
Like you say that. I'm not saying that.
Yeah.
You've written it.
And I'd like to think our path, my path, still plenty of challenges, still very busy schedule, but I have fun every day and I learn every day. I have a certain level of autonomy that makes me feel good about contributing. I feel like we are treated as experts by our LPs and really appreciated by them.
It's hard to put a price on agency, you know?
It's invaluable, and it's the one thing every human wants, right? And a lot can't get. So I don't take it lightly. But those are the two paths. I mean, we're coming full circle, but unless you're going to run the track and you have great GPA and you're willing to be hazed, you got to be an expert in something and show up with a bag of money so nobody can tell you to leave the table because you own the table.
Well, I think that can bring us into our closing question and then our closing ceremony. So we try to wrap up these podcasts. 2025, you've met your 21-year-old self, and you need to give him some advice.
Lord.
But it's 21-year-old you in 2025. What do you tell this kid?
I mean,
Just graduated USC,
that poor kid.
wants to start a co-packing business.
No, I would probably tell that kid two things. Number one, it's going to be okay, because the uncertainty of that sort of transitional youth moment is really challenging. So I'd probably help him de-risk a little. It's going to be okay. And I would also probably lean into the idea that he has a tremendous amount of influence over his own outcomes, more so than he probably is willing to recognize. There is, not to over-answer the question, but, we kind of went on a metaphysical tangent, which is always fun, but it can feel very intangible, those kind of conversations. And I like to sort of bring those back to a little more of a tangible or realistic comparison where, like we're all sitting in chairs right now. At some point in human history, there weren't chairs, right? It was a long time ago. People were just squatting. And before there was a chair, there was the thought of chair, right? Some guy, some gal, somebody had to sit up one day and go, I'm tired of this. What if there was a world where we sat on things and our backs were supported, right? And that's a kind of cheeky nod to a more metaphysical sort of manifestation concept. But everything we interact with, we look at, we touch, has been party to this thought leading action, thought leading creation
Cycle.
And I think if 21-year-old Gabe sitting there was given a meaningful vote of confidence that that's a reality, I probably could have done it a little faster. But again, also hedging that it's going to be okay also means that all the things that will happen to you between now and terminal, loop of time inflection point where I'm there again in the future, but now it's the past for him, is an okay outcome, right? The fact that I get to talk to him today or back then means we're already doing okay because I'm still here. So there's some proof in that already.
I love it. Well, allow us to transition to our closing ceremony. We like to teach and proselytize a lesson on the difference between price and value. And so, have you ever been paid to be on a podcast?
Yeah, of course.
Well, you are now a professional podcaster within our organization. And the price of this gift is $2.50.
Okay.
We hope the value of this far succeeds the cost it took for us to give it to you.
I love that. Thank you
very much.
I would say that just engaging with people like you guys, having these kind of conversations in an open format is so valuable. I mean, tabling to an audience I can't speak to, but just to myself, it's good to work this muscle out. I think we need more real transparent, real honest discussion around money, around career, around work that is not the default of American culture. And I think it does us all a disservice to not lean into a discussion about some of the stuff we talked about today.
Yeah, I hate the fake professionalism of like on like LinkedIn.
Yeah.
You know, like the kind of just copy paste posts of like, oh, so great. You know, I'm so proud. That was so great to work
LinkedIn
with
Lunatics, also another great subreddit.
Yes.
If you've ever been over there,
Wild.
It's a classic.
I guess I need to
Yeah,
check
it's
it
good.
out.
It's like memes of people on LinkedIn. So just screenshots of
But
people,
real people on
real
LinkedIn.
people on LinkedIn. Just like, ugh. But sorry to digress from your.
But anyways, that's it. So 100%, yeah, entrepreneurship is really in many ways a reflection of life and many of the other much kind of deeper aspirations that we all have, and that the business is just the, you know, kind of a manifestation of that.
Yeah.
That deeper expression, you know.
Well said. I view it too, and I mean, we could swap metaphors all day, but the entrepreneurship motivation, whatever, as, you know, it's the people that are willing to go walk into the woods with a knife,
Yeah.
right?
Yeah.
Some people want to live in their comfy home. That's a great place to be. And some people want to just walk into the forest and see if they can come out the other side, whether it's because of ego or psychosis or trauma or just pure motivation or expertise. But I think in a modern context, that's sort of the equivalent. And a life worth living is probably one where you walk into the forest every day.
Yeah.
Look around, see what
Polynesians
you're made
got
of.
on a boat knowing
Yeah.
they didn't know what was out there. So
Totally.
it's human nature.
Well, thank you so much, guys.